Well, ladies and gentlemen, let me ask all of you, are you ready to get started? Come on, yes, no, maybe you can be louder. Are you ready to get started? Okay, so let's start with some positive energy. Let's have a huge round of applause for all ourselves. Let's have a huge round of applause, ladies and gentlemen. Well, there's an India within India, and India is the world's fastest growing energy market. So our first speaker for the day is going to talk about growth of the Indian-based oil industry. Well, I would now invite on stage Mr. Pranav Kanth, Director, Corporate Development and Strategy, Rex Group. Well, if I talk about Mr. Pranav Kanth, he is an accomplished strategist and marketer with over 30 years of experience in the oil and gas and FMCG sector. He has worked with top companies like ITC, Castrol, and Total Energies. His experience span ranges from sales to marketing and communication to strategy and M&A. Pranav has held various leadership positions across national and international markets in India, Paris, and Singapore. An expert on brand strategy and distribution strategy, he has led many successful campaigns to create and establish a strong market share in highly competitive markets. Ladies and gentlemen, let's welcome Mr. Pranav Kanth with a huge round of applause.
A very good morning to all of you, and it's my great honor and privilege to be here. So the topic for the day today is the growth in the Indian base oil industry. Base oil, as we understand, is one of the key petroleum sector markets in India, and where India is amongst the most attractive market in the world. So we'll just take a quick look as to what are the key features of the market, the factors driving the growth, and what could be the major challenges as we move ahead. First and foremost, this is one fact which is not as widely acknowledged, that India is a net exporter of petroleum products by virtue of it being the refining hub. While India's crude oil production is minuscule, it imports about close to 90% of its crude oil requirement. But when it comes to the petroleum products, where we convert the crude oil into the products, that's where the story changes quite interestingly. And the story is petroleum products, they are about 254 million tons market. So that's our production by virtue of India being a major refining hub. Whereas the consumption is just over 200 million tons at 204 million tons. So the rest is accounted for by exports, which is about 63 million tons. And drilling a little deeper into it, and that's where it gets further interesting, in the sense that there is such a great similarity between the bitumen situation and the base oil situation, besides the LPG. Bitumen and base oil, which is very close to our interest, and both are almost majorly dependent on imports. While India, in both these bitumen and the base oil, remains a very strong consumer and a very fast growing consumer, but the dependence on import is very similar. That's what brings the bitumen and the base oil market context much closer together, besides the LPG. And looking ahead over the next 5 years, and if I may say, even for the next 10 years, the situation, because of the domestic slate of the refining, is that India is continue to remain in deficit of these three products. So bitumen, base oil, and LPG, for the near term, it's going to be almost entirely or if one may say so, more and more dependent on imports. And that dependence on import is the context for the attractiveness of the Indian market for these three products when it comes to the supply side dynamics. So if we take a quick look in terms of the lubricant market, because base oil is the key source material, raw material for the lubricants. So the lubricant market is India being the third largest, and again, just behind US and China, although the gap between the US and China currently is significant, but it's likely to narrow down further if you look at the next 5 to 10 years, largely because of the growth witnessed in this market in India. And current size for the finished lubricants, now here is a distinction we need to make when we say finished lubricants. So here this finished lubricant refers to the classical LOBS, lubricant oil base stock based lubricants, which is automotive lubricants and the industrial lubricants. So that, and of course the greases, that market size is about 3.4 million tons as it stands today. And when we say today, it is the latest financial year data which we are referring to. And the CAGR, the compounded average growth rate, is a very healthy clip at 3.1%. And this 3.1%, when we put it into the context of the global lubricant market growth, which hovers around between 0.5% to 1%, depending on which set of assumptions you look at. So in effect, Indian lubricant market is growing more than 3x the rate of the global lubricant market growth. And the current market size is approximately USD $5 billion. And that's where it gets interesting with the imports of 75% of the base oil requirement. And that's where the entire attractiveness of the market as a consuming destination, fast-growing consuming destination, really comes into play. And what is actually underpinning that robust market outlook? It rests on the 4 pillars of growth. First is the GDP growth. Indian economy is the fastest growing major economy in the world. Even in this volatile and turbulent global economic situation, India presents a beacon of hope, and which is also reflected in the fuel sales growth, automotive fuel sales, which is petrol, diesel, and besides the other fuel like CNG and auto LPG. Why this fuel sales growth is important? Because at the end of the day, more fuel sales means more lubricant sales. More lubricant sales mean more base oil sales. So that's underpinning the growth. Coming to the next factor which is underpinning the growth, it is the automotive sales, automobile sales. After this COVID-induced decline, India is very strongly back onto the growth path on the automobile sales. And on the industrial activity side, which is the next pillar which underpins India's growth in the lubricant sector, all the 4 factors are looking very robust and very, very attractive. Now, when we look at the long-term growth forecast, it is very important to understand that India currently, despite it being a very attractive market, the third largest market besides behind US and China, still the growth potential we believe is grossly underestimated. If you look at the per capita consumption of lubricants, which stands at about it's about 1.8 kgs per capita. Now, not only comparing it to the developed countries like USA, Japan, and Germany, and China, even when we compare it to our Southeast Asia neighbors like Indonesia, where the economics and the demographics are largely similar, the sheer potential of growth is humongous. We have a long way to grow, and as our GDP grows more and more and every other factor, the potential onto the lubricant growth upside is significantly higher. This is what we believe. Now we come down to the base oil, and we'll take some deep look as to what are the key factors. Now, this is one slide which primarily gives a very, I would say, deep down dive into it. First and foremost, the immediate situation or the immediate attractiveness is in the financial year 21-22, the March closing, India imported 4.78 million tons of base oil. That's closer to 5 million tons of imports alone. And those imports, more than 50% of it is sourced from South Korea. South Korea continues to remain the biggest supply source for the base oil for India, followed by Singapore and the UAE. And the UAE includes all the Middle East countries, but 3 countries are of particular importance here, Saudi, Qatar, and we have not separately mentioned it, it is Iran. Because as we know, a large part of the sourcing gets rerouted. So the UAE figure has to be seen in the context of it including Iran as well. We do not have the precise split of things because the data at best of the time remains challenging, but that largely is the indicative of how important the UAE is to the Indian supply situation, followed by USA. And the rest and the others account for the rest. So, and when we say 4.78 million tons, this includes LOBS, which is the lubricant oil-based stock, then the TOBS, which is transformer oil-based stocks, white oils, process oils, and the rubber process oils. So, which includes the pharmaceutical sector, the cosmetic sector, and all the industrial process sectors. So, besides the classical lubricants, it is all other user segments which are included in this import data. And South Korea, as we mentioned, by far is the largest. Now, when we look at a 5-year time frame as to how things are have moved, we have put it in terms of the consumption, the domestic production, and the imports. As we see that the domestic production has remained largely flat, if you look at the orange bar in the middle of the individual say year-wise data, and capacity constraints because of the refining configuration, refining slate configuration, remains at broadly at about 1.2 million tons. And with no major plans for new refinery capacity addition for the base oils, so the domestic production is largely likely to remain stagnant, and that brings the attractiveness of India as a market for suppliers of base oil into that much more focus because of the growing import and the growing consumption. So that underpins, again, I keep coming back to this as one of the most important markets for the base oil suppliers. Drilling down little deeper, now we are onto the base oil part as to how we know that base oil consists of group 1, group 2, group 3, and the group 4 and plus. Group 4 and plus is largely the synthetics and the PAOs, but this is the way the slate is moving. So if we see the domestic slate capacity, it is at about 1.23 million tons, and which is largely between group 1 and group 2. Group 3 domestic production is relatively much smaller and with non-existent group 4 and plus. So, and that's how the demand is, where the group 2 and group 3 are the ones which are growing the fastest. And if I may correct myself a little bit here, the group 2 is stagnating. It is the group 3 base oil stocks which are driving the growth. And what is the key reasons for this in terms of the group 3 focus is because India has implemented the latest emission norms, which is called Bharat Stage 6, which is equivalent of the Euro 6 emission norms, which is currently in force in Europe and all other developed markets. And we have been here since last year. So that has led to the major shift into the base oil requirements and the major upgrade into the base oil requirements. Now, getting onto a little bit of technical side, this drive towards the group 3 is not only restricted to the automotive and industrial, but across all the categories, which includes transformer oils, white oils, and heat transfer fluids besides the automotive and industrial. And it is driven by the performance parameters of the group 3 and group 4. They are the ones which are delivering significantly superior performance across the spectrum of requirements. And that is what makes it a very secular trends toward group 3 and group 4 plus. And for the suppliers, why this is of importance? Because Indian market continues to upgrade itself towards the more premium grades. So a supplier with a strong production and supply chain capabilities which are geared toward group 3 and plus, they would find Indian market one of the most attractive in the world. Now we come down to take a quick look as to how the lubricants market is. Base oil, as we mentioned, is the core raw material, and the biggest consumption of the base oil is in the lubricants. Now, that's here we have presented a snapshot as to what the lubricant market looks like, overall size of 3.2 million tons, and top 10 players. They control about 70% of the market. And those top 10 players are, besides the 3 domestic refiners, which is IOC, BPC, and HPC, which account for almost 50% of the market, 41% of the market. The rest are still dominating the market. So strong presence of the domestic refiners in the finished lubricants, and equally strong presence of the key leading players of the market. So we have all the major brands, including BP, Castrol, Total, ExxonMobil, Shell, Valvoline, and as we know, Valvoline has recently been taken over by Saudi Aramco. So India remains a market to remain invested in, and there are more players joining in. And if we delve a little bit deeper, what we see, it is that the other segment, which constitute about 24% of the market, they are growing significantly faster than these established top 12 players. And that's where the opportunity for new players arises. And that makes the market very, very interesting. Because it's not only the established top super majors which are leading the market, they currently control the market to a large extent, but the growth is driven by significantly smaller and the lesser known players. And that chunk is increasing. So what we are likely to see, that the current 24% share, which is occupied by the others, quote unquote, is likely to be reaching about 30% plus over the next 3 years because of the growth rate differential. And when we look at the marketing side of things, Indian market is unique in terms of its distribution complexity. And what is the key complexity or the key uniqueness of the Indian market is the sheer number of lubricant retail outlets which exist in the market, which at a conservative estimate is more than 250,000 outlets which are there in the lubricant. Now, how this is important? Unlike any other country, this figure of 250,000 touch points effectively means the consumer or the vehicle owner can go to any of these 250,000 outlets and buy lubricants. So as a player with an ambition to make a mark, one has to reach out to a very large percentage of these outlets to make the product available. So the market share would be a function of your distribution, reach, and penetration. And that is a longer-term marketeer's game, which requires deep market knowledge, patience to build up the distribution network, and to sustain it. So that's what sets Indian lubricant market very differently from any other global market. The sheer size, or one could say the fragmentation or the challenge of reaching out to, for instance, 50,000 of these 250,000 outlets to start making some impact. It is more similar to a consumer goods market in India. So where the branding and distribution and the pricing and the below-the-line marketing activity really come to the fore. So it's a market for players who have patience and long-term perseverance to make a mark in the market. So if I were to spend a couple of minutes more, we see the largest player. Now, I had just shortlisted some of the key private players because they hold the maximum distribution strength. As a marketeer, what you are looking at, one is the overall market share, and second is the price premium. So the price premium is very strongly correlated with your distribution strength. Castrol, which is most widely available at about 120,000 lubricants outlet, also commands the largest price premium. So on a 100 index, if we take Castrol as the price index, so every other player is little bit lower. And as they improve their distribution, they get closer and closer to the market leader. So that's what kind of sums up the key challenge of the Indian lubricant market. Now, what is driving the base oil requirement? It is driven largely by the automotive segment. And what are the key drivers? One is the fuel efficiency. Second is the emission norms. How it has impacted the lubricant market? The shift to the lighter viscosity grades. So earlier it used to be monogrades, then it came to multigrades, 20 Ws. Now from 20 Ws, it is moving to 15 Ws, the 10 Ws, the 5 Ws, and particularly in the passenger car segment market, it is moving to the 0 Ws. So we have here highlighted three key automotive segments, which is the car segment, the motorcycle segment, and the heavy-duty commercial vehicle segment. So across the board, it is moving to the lighter viscosity grades. That trend is little less evident in the HDMO commercial vehicle, where it is likely to take another 5 years by most estimation. Now, how the future trends when we look at the consumer automotive lubricants and the commercial automotive lubricants. It is efficiency, the fuel efficiency and the emission norms, which are the key trends, and this is a secular trend. It will keep on getting tighter and tighter, and which is leading to the shift towards the lower viscosity grades and sales and service network. This pertains to the distribution side of it. It is getting more and more challenging, and it is getting more driven by the OEM standards. And OEM standards, different OEMs have their own different standards. So we have the API standards, we have the ILSAC, we have the JASO, we have the ASIA. So all these differing OEM standards for lubricants continue to coexist in India, and it's one of the key challenges for a lubricant supplier to be meeting different set of requirements basis the different OEMs requirements. And evolution of independent workshops. Now, there are two kinds of workshops. One is the OEM workshops, one is the independent and non-franchise workshop, which means they are independent of any OEMs. So those are the sectors when it comes to the retail distribution, which are growing significantly faster than the OEM-driven workshops. And rising awareness among end users about the premium quality of lubricants required for their vehicles. And demand for synthetics is growing significantly faster than the overall demand. And as we said, in commercial automotive lubricants, this trend is relatively slower, but no less steadier. So it's equally steady, but going at a pace which is significantly slower than the automotive side of the market. Synthetic currently is almost at next to negligible level in the commercial side because of the price sensitivity of the segment, and maintenance practices are evolving, but less in line with the global. And tightening emission norms remains one secular trend cutting across the segment. Extension of drain oil intervals, which brings a bigger challenge onto the growth of it. Till about 5 years back, the commercial vehicle segment drain intervals were about 50,000 kilometers. Now it is moving to 70 to 80 and even 100,000 kilometers between drain intervals. So that is significantly impacting the growth prospect of the segment. And the OEM tie-ups, they remain the key drivers. And to conclude, Indian market is a great market for smart marketeers. It is not just a supply-side destination, it's a marketing-driven market. So any player with a deep interest would need to have a longer-term horizon to make an impact into the market. Because OEMs and private labels, they are growing at the expense of established lube brands. The highly profitable, the aftermarket, that remains the most profitable distribution channel. And when we say the most profitable distribution channel, in terms of the unit GMVC, the gross margin at variable cost, at the unit margin for the suppliers, the delta could be 5x to 7x against a normal unit margin of about USD $20 per ton when a supplier is supplying to the OEM brands. If it were to sell its own brand in the aftermarket channel, the margin, average margin is about $120 per ton and more. So $20 per ton unit margin when you just feed the OEM suppliers vis-a-vis $120 per ton unit margin. So it's a 6x delta. So that's where the biggest attractiveness of the market lies. So distribution strategy holds the key, which is a relatively unglamorous side of the market because it requires patience, perseverance, and investment. And there is a greater willingness from the end users, the customers, to pay a price for superior product, which brings into play a marketing approach, a marketing-driven approach to the market. And strong growth in fuel sales. India's fuel sales were amongst the fast to rebound after the COVID lockdowns. And currently, India remains the fastest growing automotive fuel growth market in the world. So that underpins the growth of the lubricant industry in India. Thank you.
Well, thank you so much, Mr. Pranav Kanth. And I would now request our audience, if you have any questions, please feel free to ask your questions. Yes.
Hello, thank you very much for your interesting presentation. My name is Dmitry from Argus Media, a pricing agency. As a pricing agency, we can see some very high volatility of prices of base oils everywhere around the globe, including India. So my question is, are you aware of any financial tools to manage with risk? I mean, hedging. Is it common in India? Because currently, these days, the recent years, obviously, this market looks very volatile in terms of pricing. Thank you.
Some large players have been hedging their risk, but I'm afraid, basis my experience, those hedging strategies have not really panned out the way they were envisaged, and many times there have been losses onto the hedging strategies. And I'm talking from my experience in Total, where I spent about 15 years. And we moved away from hedging. And I'm saying it from my personal experience in Total. But at the same time, the big players, they continue to hedge. But that's not something I would be in a position to really go very deep into, because I don't have any personal direct exposure to hedging. So I'm afraid if I'm not able to answer your question to the extent you would have liked.
Well, thank you so much, Mr. Pranav Kanth, for your insightful presentation.
Thank you.